Our open trading platform links to 1,300 global credit institutions and provides $8 billion in daily tradable liquidity. Join us.
Welcome to Trader TV Fixed Income, your insight into the trading climate for professional bond investors. I'm Dan Barnes. In September's show, we're speaking with firms who see artificial intelligence as the future for trading bonds. We're talking with Jim Switzer, Global Head of Fixed Income Trading at AllianceBernstein, about automating the fixed income trading desk, and Giuseppe Nuti, Managing Director and Global Head of the Central Risk Book and Data Analysis at UBS, about using artificial intelligence to enhance bond trading. Jim, welcome back to Trader TV.
Thanks for having me, Dan.
So tell me, why should investors care about efficiency on the trading desk?
Well, I think before we talk about efficiency on the trading desk, we need to step back and talk about efficiency in the investment process, because that's what investors should care about. And efficiency on the trading desk is just one part of that.
Okay.
So when you think about an investment process and the connectivity between portfolio management decisions and portfolio construction, the bottom-up construction of those portfolios at the research and trading level, it's very important that we think about how we systemize our processes and bring all those processes together. Then you can ultimately get down to the trading desk and say, what are the efficiencies on the trading desk? And ultimately, look, the holy grail of trading is pre-trade transparency, is having all that information at your fingertips before everybody else and in a more ordered manner. And that's ultimately what we've done. We've spoken about it before with our Algomi Alpha tool, which is just an aggregator that's bringing all that information in. And we talk about how many messages we get in, 3.5 million messages a day, and how to put some kind of order and structure around that. And that's where Alpha comes in, which is our liquidity tool, which has digitized liquidity, our view into liquidity. Our Prism tool, which is basically digitized our fundamental view. We have our quant views, which is already digital. And where all those intersect, that's where our bot technology, Abby, takes over. And that's a big part of the efficiency, whether it's workflow for the APMs, building orders and getting into the trading desk, or actually highlighting to us trends in the market or things that we're supposed to be aware of. That's all part of it. So a client should care about that, because in the end, that's all driving best X. That is all driving optimization of their portfolios, and hopefully actually generating real alpha into the portfolios.
So how much of the bond trading process at the moment do you think you can automate?
Well, I'm probably going to annoy a lot of people when I say this, but it's 100%.
Okay.
And basically, you have to take a step back. Are we talking about electronic execution, or are we talking about electronic connectivity? Because if we're talking about connectivity, then we should be able to do everything, automated in some kind of electronic way. So 80% of our trades of our notional bonds that we trade are still done, bilaterally over the phone. But we do not process them manually anymore. Everything is sent to some kind of platform where we can have it auto spot, auto X, or whatever it might be. We break everything into high touch and low touch. All right, we're building our low touch capabilities right now as we speak, trying to build algos, sensitivity to our algos to be able to increase the bands or tighten the bands depending on what we're trying to do. And we're trying to auto X as much of this stuff away. We might have a beta trading desk and an alpha trading desk. The alpha desk, the ones that are actually looking for alpha for our clients' portfolios, and the beta where it's just process and moving beta as automatically and systematically as we possibly can.
And when we're talking about the automation, are we talking about artificial intelligence? Are we talking about more robotic process automation? Whereabouts does this sit?
I would say it's more of a robotic process automation, very algo heavy, fixed algos, if you will, where there are specific rules, and that's what our robots are looking for. I could see down the road, our robot is called Abby. We have Abby 1.0 and we're working on Abby 2.0. Abby 1.0 was there just to systematize and streamline our order building process, to allow our associate portfolio managers to get orders processed, run compliance, and get it to the trading desk quicker. Abby 2.0 is something where we can actually have Abby recommending certain bonds or certain sectors to us based on what she sees in our algos and the rules that we've created. Down the road, we could see machine learning, and that's something that we're thinking about in Abby 3.0, where she'll have the ability to have flexible algos based on the feedback she's getting either from a PM or a trader on the success. Yes, I want to do the trade, or no, I don't. Basically, what we're trying to do is identify are there bids filling in? Are the offers filling in? Is the market leaning one direction? And what that does is it tells a trader sometimes to hurry up or to slow down.
Yeah.
The market is coming your way, or the market is suddenly flipped. A sector specifically has flipped, and we see that right away with our tools. So when you think about BestX, and this is probably Pandora's box here, but BestX used to be a very two-dimensional process for us. It used to be point of entry and then measure how did we do relative to our print, relative to the quotes at that time. Mm-hmm. And what we're trying to do is say, okay, if we systematize all our processes and we can come up with ideas quicker because we see them in the market, Abby can build us orders faster and get them to the trading desk quicker. And we have tools that are telling us the liquidity score is not just a liquidity score on a particular bond, but a liquidity score on a particular bond on the bid side or on the offer side, because we believe there's 2 liquidity scores for every bond.
Right.
And then you have a momentum indicator that's telling you that bond, that particular QSIP, or that ticker or that sector, bids are fading, offers are filling in. That will help you address speed. And to us, when we take all that together and put that into the BestX process, we start to look at something that's much more 3-dimensional or 4-dimensional. What you didn't add on to that is the strategies you have to go trade. Mm-hmm. The typical ways of RFPing bonds or bid wanted in comps, whatever it might be, are changing now, and a lot of that's driven by the ETF ecosystem that we're seeing develop out there.
Do you mean the fact that there's more passive investment in the markets?
I'm saying we can use the ETFs. The sell side right now is managing a lot of their risk through the create redeem process, through the ETFs. So now if we go to them to manage our beta risk in portfolios, just slice of beta, we want to take some beta out, we might want to liquefy it into a different type of asset class or a different security. Maybe we want to sell cash bonds and take total return swaps, or we want to take index, just to have a different certainty of liquidity, if you will. We can go to those dealers and say, here's the risk, this is the slice of beta. Now, if that's not truly a diversified basket, they can augment that basket with risk off of their desk and turn around and go back to the ETF, deliver that in, and move it out that way. So there's a lot of really interesting things that are going on in the market in terms of how we're going to move risk, how we're going to trade going forward.
That's great. Jim, thank you very much.
Thanks, Dan.
Now we're going to speak with Giuseppe Nuti, Global Head of the Central Risk Book and Data Analysis at UBS, to hear how it is employing machine learning to enhance bond trading for its clients. What are the quantifiable advantages in using machine learning to enhance bond trading?
Well, this particular initiative is really about the corporate bond space, where liquidity is fundamentally the premium commodity. Mm-hmm. This is a recommendation engine ultimately, right?
Sure.
So the sort of Netflix or Google's at its core a recommendation engine in the sense that you put something into the Google search engine and it recommends a list of websites, very much like Netflix recommends movies for you to watch or series or what have you. And this is exactly the same thing. It recommends our salespeople a list of clients to call, to trade versus our access. So here, what we're trying to do is build a system that enables us to say, well, these are the things that we want to do. This is the patterns that we've seen in the past from our clients. Mm-hmm. This is the public data that we can scan, and through that we can say, well, we should really call this 10 clients because they're most likely to respond. So in terms of the advantages, first of all, you're more likely to do the trade you want to do, and that's a pretty obvious advantage.
Yes.
Secondly, you cover your clients more effectively. They will get a more pinpointed phone call, and that allows our salespeople to cover their clients more efficiently. Really.
And so, what do we mean by machine learning in this context?
Where I think, for us at least, the machine learning comes in is trying to augment that, both the data set and the way that we analyze it with more features. Like a perfect example is we have this big list, it's an Excel spreadsheet, nothing fancy, and we have a bond that we're trying to buy. We say, hey, this fund here is traded in the past, we should give them a call. But maybe that fund is a passive fund that just does index rebalancing, and that happens only at month end. The month end is just a feature. Some features are obviously much more complex. Maybe there's a RV fund, a relative value fund that wants to trade a particular US dominated corporate bond versus its equivalent in euros when the spread becomes, that's quite a complex feature. I think where machine learning really does come into play is in being able to throw a large number of possibly interdependent features and analyzing all of the data together and say, well, this particular fund is quite likely to respond when the spread crosses, but it has to also mean that the treasuries has to be within the Z spread has to be within this level. And so combining rules in a way that it would take a human an inordinate amount of time to do it by hand. The problem, I think, there is that there isn't actually that much data. Most of it is price data. And price data, if you were to sort of measure the amount of information there is versus data, there's just not that much information.
How do you train a machine learning system on that data set if it's so sparse?
That's a great question. So there are two challenges there. One is, I'd say the more obvious one, which is just the statistical significance. Right. In other words, yes, we've seen this particular two funds trade this bond before, and then we can now start making all sorts of theories about what triggers that and the spread here. But if we've seen two data points, well, it's kind of irrelevant. Yeah. Or more interestingly, what about the new bond that's just been issued? There's zero data points by definition. So I think there, and from the statistical significance point of view, this is a reasonably well-studied aspect in academia, and I think, you just have to approach it that way. So the other more challenging aspect is actually trying to squeeze more information out of the data.
Right.
And I think this is probably where most of the work goes for us. And the best way to sort of illustrate that is, I'd say, imagine that a particular client, trades a financial name quite actively, in the 5-year sector. Well, if a new bond comes in and it's just been issued, and this is day 2 of the bond, giving them a call is probably not a terrible bet, right?
Yeah.
And so here, linking the information in such a way that it makes sense is fundamentally the challenge of making the most out of what is a sparse data set.
So, and it strikes me then that there's a certain amount of time that you need to be in this to build that data set, to learn those lessons.
Well, yes, and I think probably the point that you're bringing up is the single most important point of why we're focusing on this so much. I think in our industry in general, there are certain situations which present a clear first mover advantage, but they're not that common. In this particular case, I think there is a bit of a first mover advantage in the sense that it's quite likely that more and more firms are going to go this way, and more of these algorithms are going to become more and more sophisticated, both on the buy side and on the sell side, which basically means that the more data you have, the better your recommendation.
Giuseppe, thank you very much.
Thank you for having me here.
I'd like to thank Jim Switzer of AllianceBernstein and Giuseppe Nuti of UBS for their insights into the use of artificial intelligence in bond trading, and of course you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradertv.net.